At the height of his power, one man was worth more on paper than entire nations. His net worth rose by billions in a single year. Headlines called him rich beyond comprehension. Then one morning, a line of code changed, a market shifted, and that fortune evaporated faster than it was created. No invasion, no theft, no fire, just a repricing. The paradox is brutal and rarely discussed. He had wealth, but he never truly had value. And when the system adjusted, the difference became fatal. That distinction between wealth and value is the quiet fault line running through every financial system in history. It determines who survives crashes, who quietly compounds power, and who discovers too late that their riches were conditional. This is not a motivational slogan. It is a structural reality built into money itself. To understand what really makes someone rich, you have to step back before stocks, before banks, before modern currency, to a time when wealth and value were inseparable because survival depended on it. In early human societies, value was concrete, land that produced food, tools that increased output, skills that kept a tribe alive. Wealth was not measured by accumulation but by contribution. A hunter with excess meat could not hoard it indefinitely. It spoiled. Value had to circulate or it vanished. Power came not from possession alone, but from usefulness. As civilizations grew, surplus emerged. Agriculture allowed storage, storage allowed hierarchy, hierarchy allowed abstraction. Grain became a unit of account, silver became portable value, gold became trust-made, tangible. For centuries, wealth and value still aligned closely. Gold had no yield, but it had permanence. Land fed people. Merchants who controlled trade routes created real economic surplus. Even kings understood this intuitively. A crown without productive land or loyal subjects was just metal. The first major separation between wealth and value began quietly with financial innovation. In medieval Italy, merchant banks learned to create claims on wealth rather than wealth itself. Bills of exchange allowed trade without moving metal. This was efficient. It also introduced leverage. One piece of gold could support multiple promises. As long as trust held, this system created growth. When trust broke, it created collapse. This pattern would repeat again and again. By the time of the Industrial Revolution, the gap widened further. Capital markets allowed ownership to be divided, abstracted, and traded. Shares represented claims on future profits. Bonds represented claims on future taxation. Value was no longer what existed, it was what was expected. This shift unlocked enormous progress. Factories, railroads, electrification, but it also planted a dangerous idea that rising prices meant rising wealth, regardless of underlying productivity. By the early 20th century, this confusion became systemic. Stock markets boomed, paper fortunes multiplied. Wealth appeared to grow faster than the real economy. Then came 1929. When the crash hit, trillions in paper wealth vanished. But something strange happened beneath the panic. Factories still existed, skills still existed, land still existed. What disappeared was not value, it was the price people were willing to pay for claims on it. Those who survived the Great Depression were not those who had appeared richest in 1928. They were those who controlled real assets, produced essential goods, or held liquidity when confidence collapsed. The lesson was learned, then forgotten. After World War II, a new era promised stability. Bretton Woods tied currencies to gold. Governments promised restraint. Growth surged. But again, abstraction crept in. As economies expanded, credit expanded faster. Financial instruments multiplied. Derivatives allowed exposure without ownership. Wealth became increasingly By the late 20th century, a new archetype emerged: the paper billionaire, net worths driven by equity valuations, not cash flow, balance sheets bloated by expectations of perpetual growth. This is where the confusion hardened into dogma. People began to equate wealth with numbers on a screen. Net worth statements replaced balance sheets of production. Social status followed valuations, not resilience, and the system rewarded it until it didn't. The dot-com bubble was an early warning. Companies with no profits, no durable value, reached astronomical valuations. When reality intervened, trillions vanished. The infrastructure of the internet survived. The paper wealth did not. Then came 2008. Housing prices soared. Mortgage-backed securities multiplied. Ratings agencies stamped risk as safety. Wealth appeared everywhere. Homeowners felt rich. Banks felt invincible. But value had not grown at the same rate. Incomes lagged. Productivity stagnated. Debt filled the gap. When defaults began, the illusion shattered. Again, assets remained. Houses still stood, but prices collapsed. Wealth disappeared. Value reasserted itself brutally. Governments responded by doing something unprecedented. They protected wealth signals rather than value creation. Central banks cut rates to zero, then below. Asset prices were stabilized, markets recovered. Inequality exploded. This response changed the rules permanently. From that moment on, wealth became increasingly disconnected from contribution. Asset ownership, not productivity, became the primary driver of financial success. Stocks rose not because companies produced more, but because discount rates fell. Real estate rose not because housing improved, but because credit expanded. People who owned assets grew richer by default. People who worked for income fell behind. But even within this system, the difference between wealth and value still mattered. Those who understood the game accumulated assets that generated cash flow, pricing power, or scarcity. Those who chased price appreciation alone became dependent on continued policy support. The modern economy is full of examples. A founder whose net worth depends on a single stock price is wealthy, but fragile. A business owner with diversified cash flows and low leverage may appear poorer on paper, but is structurally richer. A country with a reserve currency can print wealth signals indefinitely. A country with productive capacity and energy independence holds real value. The same applies to individuals. Consider pensions. On paper, they represent wealth. In reality, they are promises dependent on future taxpayers and markets. Their value depends entirely on demographics, productivity, and policy choices. Consider cryptocurrencies. They represent a new attempt to redefine value scarcity enforced by code rather than trust in institutions. Some see liberation. Others see speculation. The truth is more uncomfortable. Price does not equal value, even when scarcity is real. Bitcoin's price fluctuates wildly. Its value propositions, censorship resistance, fixed supply, portability exists independently of price. Many who buy it chase wealth signals. Few understand the underlying value claim. This misunderstanding repeats everywhere. Social media celebrates net worth milestones. Rarely does it ask, how durable is this wealth? What happens if interest rates rise? If liquidity dries up? if policy shifts? History answers these questions relentlessly. Wealth that depends on favorable conditions is not wealthy, is exposure. Value, by contrast, is what remains when conditions change. During hyperinflations, paper wealth explodes numerically and collapses in reality. Those with real assets land commodities, skills preserve purchasing power. During deflations, leveraged wealth implodes. Those with liquidity and low obligations gain control. The pattern is consistent across centuries. So why do most people never become financially free? Because the system trains them to chase wealth signals instead of value creation. They are taught to maximize income without understanding fragility, to buy assets without understanding cycles, to measure success by price, not control. They are told diversification means owning many correlated assets. They are told debt is leverage, not obligation. They are told growth is permanent. And crucially, they are excluded from the mechanisms that convert value into durable wealth. Ownership structures, tax optimization, monetary policy access, asset protection strategies. These are not taught. They are inherited or discovered painfully. Financial freedom is not about being rich at peak valuation. It is about surviving regime changes. Every major economic shift redistributes wealth, not randomly, but systematically. Those holding claims suffer. Those holding control benefit. This is why dynastic wealth looks boring. It avoids volatility. It prefers steady cash flow to explosive growth. It sacrifices upside to preserve downside protection. This is also why sudden wealth often disappears within generations. Without understanding value, wealth dissolves. Modern parallels are accelerating this cycle. Artificial intelligence will inflate valuations while compressing labor value. Asset prices may rise while incomes stagnate. Wealth inequality may widen further. At the same time, demographic shifts will strain pension systems. Debt burdens will pressure currencies. Climate and energy transitions will reprice entire sectors. In this environment, surface-level wealth is more dangerous than ever. The richest-looking portfolios may be the most exposed. The quietest balance sheets may be the most resilient. True wealth increasingly looks invisible. It looks like optionality, low fixed costs, geographic flexibility, ownership of productive assets, skills that transfer across systems. It looks like the ability to say no when conditions turn hostile. That is value. And value, unlike wealth signals, compounds quietly. 3 takeaways matter. First, wealth is a number. Value is a relationship. One can vanish overnight, the other endures across cycles. Second, systems reward behavior temporarily and punish misunderstanding permanently. Chasing price without understanding structure is not investing, it is gambling on stability. Third, financial freedom is not about escaping work. It is about escaping dependency on fragile assumptions. The warning is simple but uncomfortable. The next transition will not announce itself politely. It will reprise reality while most people argue about numbers. And the open question is this: if your wealth were revalued tomorrow under different rules, what would remain? If this changed how you think about money, power, and what being rich actually means, stay with the channel, because the stories that matter most are not about how fortunes are made, but about how they survive when the rules change.